Hello everyone, welcome to our part 2 of company accounts. Before moving to the part 2, I hope that all of you have completed our previous problem which I gave you in our part 3. So let's move on with this. In this part 4, we are discussing about the different methods of issuing shares. I mean different pricing methods of issuing shares. Shares can be issued at par, at premium and at discount. So in this part, we'll be dealing with how these shares can be issued in par or issued in premium or issued in discount, the according treatment of issuing in these three categories. So issuing shares at par means issuing as its face value. For example, 1000 equity shares of rupees 10 each is issued at rupees 10. So when the shares are issued at the same face value, it is known as issued at par. So in such case, there is nothing which is there is nothing to worry about it because shares are issued at the same price of its face value. So there is no much discussion is needed. Then issue of shares at premium. Issuing shares at premium means when the shares are issued at a price more than its face value. See the example here. 1000 shares of rupees 10 issued at rupees 12. Shares of rupees 10 each issued at rupees 12. Which means there is a price increase of rupees 2 and this 2 is known as share premium. This 2 is known as share premium. So when the shares are issued at a price which is higher than its face value or nominal value, it is termed as issue of shares at premium. And this premium, this 2 rupees premium will be transferred to an account called security premium account. So when these kind of shares are issued at premium, there will be slight difference or slight changes in our accounting treatment. We have to transfer this premium amount to this security premiums account. So now we will see the accounting treatment of issue of shares at premium. So as I have already said, this premium amount will be transferred to an account called security premium account. Security premium reserve account or security premium account is the account where the premium amount of shares are transferred. So this premium is kind of income for the business. See, when a company issuing shares of 10 each at rupees 12, they are getting 2 rupees extra on each shares. So this 2 rupees is a kind of income for that business. So it is known as security premium and it will be transferred to the security premium reserve account. So later, whenever the companies are needed, they can utilize this premium amount for various purpose. So according to section 52 of the Companies Act 2013, the share premium may be applied only for the following purpose. So this premium amount can be utilized for any of these four purposes. Any company cannot utilize this rupees 2 except for these four purposes. So let's see first one. To issue fully paid bonus shares to the extent not exceeding unissued share capital of the company. So whenever this company is issuing bonus shares to its members, this premium amount can be utilized. So the first case is issuing bonus shares. What do you mean bonus shares? When the company is having surplus amount of profit other than or avoid in order to avoid the liquidity problem, the company will be providing bonus shares to the shareholders instead of paying dividend. So this share premium can be used for paying of this premium. And the second is the right of preliminary expenses of the company. As we know, at the preliminary stage of this company, it may have different expenses, different promotional expenses or registration expenses. There are different types of preliminary expenses. What do you mean by preliminary expenses? All those expenses incurred before the company came into existence is termed as preliminary expenses. To write off such kind of preliminary expenses, this kind of amount can be taken. The security premium reserves balance can be taken for write off preliminary expenses. Then third, to write off the expenses of or commission paid or discount allowed on any of the shares or debentures of the company. So sometimes the company may have to pay commission or any some legal expenses, or sometimes company will be allowing discount on issue of shares or debentures. During such kind of expenses, these balances of security premium reserve can be taken. So the premium amount can be utilized for the write-off expenses regarding shares or commission regarding shares or discount while issuing shares. And the fourth case is to pay premium on the redemption of preference shares or debenture of the company when the company is redeeming their preference shares or debentures. Redeeming means when the companies are paying back the preference shares or debentures to its holders. If the company is redeeming these preference shares at premium, so in order to make up that premium expenses, the fund can be utilized from the security premium reserve. So for these four purposes, the security premium reserve can be utilized. So let's sum up. First one, to issue fully paid bonus shares, and to write off preliminary expenses, then to write off expenses on issue of shares such as commission, discounts, etc. Then to pay premium on the redemption of preference shares. So these are the four purposes for on which the balances on security premium reserve can be utilized. So when the company earns premium on its issue of shares, that premium income can be utilized only for these four purposes. Okay, yes. Now we are going to deal with the accounting treatment when the shares are issued at premium. So the premium amount can be collected along with the application money or allotment money. Can be collected in these two ways. So whenever the application, when the uh, premium amount is collected along with the application money, our journal entry will be like this. Whenever the application money received along with the premium, on the receipt of this money, our journal entry will be bank account data to share application. Suppose a company issued 100 shares of rupees 10 each at a premium of rupees 2. Company issued 100 shares of rupees 10 each at a premium of 2, on which the shareholders have to pay rupees 5 on its application. So it is also said that the application money includes premium. If the application money includes premium, so if the application money includes premium, the premium amount is 2. So the actual application amount is 3, but including premium, the shareholders have to pay rupees 5 on its application. So whenever the shareholders apply for these shares, they have to pay rupees 5 on each shares. So if the company is issuing 100 shares, they will be getting 100 into 5, 500 rupees. Bank account data 500 to share application 500. And the next stage, we have to transfer this share application amount to the share capital on the acceptance of this order. So there are 500 rupees in share application as we received. Here we received rupees 500, and now we have 500 rupees in our share application account. Now we want to transfer this application money to the share capital. So let's see, the real application money is rupees 3 only. That only we can transfer to the share capital. So 3 into 100, rupees 300 will be transferred to the share capital, and 200, or with this remaining 200 is premium, it should be transferred to the security premium account. So this is how we record issue of shares at premium and when the premium is collected along with the application. And there is another treatment when the premium is payable with allotment money. Sometimes or most of the times the premiums is payable along with the allotment money. So in such a case, the treatment is like this. Unlike the application money, in case of allotment money, first of all we have to make due this allotment money. Suppose the company is issuing 100 shares of rupees 10 each at a premium of rupees 2. A premium of rupees 2 and payable as 3 on application, 5 on allotment, and the allotment includes premium. Allotment money includes premium. So it means the actual allotment money will be 3 plus 2 premium, and the shareholders have to pay rupees 5 on allotment. So when the allotment money due, making due, the journal entry will be like this. Share allotment account ledger to 100 into 5, rupees 500, out of which allotment money should be transferred to the share capital. So actual allotment money is rupees 3. So 300 will be 3 into 100. 300 will be transferred to the share capital, and the remaining 200 is the premium should be transferred to the security premium account. And when so this is how we making due the allotment. So when the allotment made due, they will get the cash bank account to share allotment rupees 500. So this is how we record when the premium is collected along with the allotment money. So here is an example when the premium is payable along with application money. So listen this question. Jupiter Company Limited issued 10,000 equity shares of rupees 10 each at a premium of rupees 2 payable as follows. So the shares are worth of rupees 10 and now it is issued at a premium of rupees 12. So the total value of share is rupees 12, and it is payable as one application rupees 5 including premium. So what is our premium amount here? Premium is 2. Then what will be the actual application? 5 minus 2, 3. So 3 on application and 2 on premium. So total application money is to be paid as 3 plus 2, 5 on allotment 2 and balance on first and final quote. And this issue was fully subscribed and all the money were duly received. Record the journal entries in the book of company. So let's start recording this problem. See, when the company receives application, how much amount they will get? They are issuing 10,000 shares. Then what is the application amount? Application amount is 5. So 5 into 10,000, 50,000. Bank account to share capital, 50,000. Application money received rupees 3 per share along with the premium rupees 2 per share. Total 5 into 10,000. So total 50,000 rupees will be received as share application. Then on the transfer of the share application, the actual application money is rupees 3 after deducting the premium. So this 3 rupees should be transferred to the share capital. So 3 into 10,000, 30,000 is transferred to share capital. Then remaining 2 rupees is to be transferred to the security premium account or security premium reserve account. So the remaining 2 rupees, 2 rupees for the 10,000 shares, 20,000 shares is transferred to the security premium account. So this is how we record the shares issued at premium, and the premium is collected along with the application money. So now the application money is received and transferred to the share capital, and premium also received and it is transferred to the security premium account. Then next we have to make the allotment due. Here see, share allotment account to share capital, rupees 3 is to be paid on share capital. Share allotment account to share capital, rupees 3 is to be paid on allotment. Then they will be receiving the allotment money, bank account to share allotment. The next they have to make share call, I mean share first call or share final call. So as all of you knows this, I'm now doing that. Then moving on. Then here is our example 2, which deal with when the premium is payable with the allotment money. Same problem, but the premium is payable with the allotment money. The company issued 10,000 shares of rupees 10 is at a premium of rupees 2, payable as rupees 3 on application and rupees 5 on allotment, including premium. So our premium amount is rupees 2 here. So the balance will be the allotment money. So 5 minus 2, 3 will be the allotment money, and balance on first on final call. So let's see how we can record this transaction. So first they will be receiving application money of rupees 3 on rupees 10 on 10,000 number of shares. So bank account to share application money received for 10,000 shares at rupees 3. Then they will be transferring this share application to the share capital account, the same amount. Then next we have to make the allotment money due. So the journal entry is what? See, share allotment account to share capital to security premium. The total share allotment price is rupees 5 including premium. So 5 into 10,000 rupees 50,000 is to be collected in the form of allotment money, out of which rupees 3 is payable as allotment and rupees 2 is payable towards premium. So 3 into 10,000, 30,000 is payable towards the allotment money. So that amount will be transferred to the share capital, and the remaining 2 into 10,000 is the security premium. That amount will be transferred to the security premium account. So this is how we making allotment due when the premium is collected on the allotment. So share allotment account at 50,000 to share capital 30,000 to security premium 20,000. Allotment money due for 10,000 shares of rupees 3 per share and premium rupees 2 per share. Then next we have to get the allotment money. Bank account to share allotment rupees 50,000. So this is how we make changes when the application or premium is collected along with the allotment money. Then next we have to make the balance due, balance first and final call. So there will be only one call. All the entire balances are collected from only single. So how much we have to get in balance? Rupees 3 is collected on application, 5 is collected on allotment. So total paid up value is rupees 8 on share. Actually the share is issued at rupees 12 including premium. So remaining 4 rupees is to be collected from each shares, and this 4 rupees will be collected as first and final call. So there will be only one call, first call, first and final call. So first we'll make the allotment due, final call due. Share first and final call account debted to share capital, as you know, 4 into 10,000. Then later they will be receiving a bank account debted to share first and final call. So this is how we record this transaction when the premium is there along with the allotment money. So shares issued at premium means when the shares are issued more than its face value, it is termed as shares issued at premium. The next third category, issue of shares at discount. Whenever the companies are issuing shares less than its nominal value is known as issued at discount. See, 10,000 shares of rupees 10 issued at rupees 9. So there is a discount of rupees 1. So whenever the company issues shares less than its nominal value is termed as issued at discount. But according to section 53 of this Companies Act 2013, as per the new revision Companies Act 2013, company cannot issue shares at a discount except in the case of sweat equity shares. So nowadays company cannot issue shares at discount except in the case of sweat equity shares. What do you mean sweat equity shares? Sweat equity shares are the shares issued by the company to its existing employees or directors for consideration other than cash. So sweat equity shares means when the companies are issuing shares to the existing employees or directors for the consideration other than cash is termed as sweat equity shares. So no other cases company cannot issue shares in the discount. So there is no worry about it because the company cannot issue shares normally at discount. So there is no need of learning this journal entry. So now we have completed our three cases. First one, shares issued at par, which means when the shares are issued at a price which is same as face value or which is equal to face value is termed as issued at par. And when the shares are issued at a price which is higher than this face value, which is termed as issued at premium. And when the shares are issued at a price which is less than the face value, it is termed as issued at discount. So that section is over. Next, issue of two classes of shares. What are the two classes of shares? Yes, equity shares and preference shares. So the company can issue both the shares, equity shares and preference shares. So whenever the companies are issuing both these classes of shares, they have to pass the journal entries separately for each class of shares. When a company issues both equity and preference shares, then the journal entries are to be written separately for each type of share capital. For example, if the companies are issuing, see the example here. A company issued rupees 20,000 equity shares of rupees 10 each. There is the equity shares, 20,000 equity shares of rupees 100 each, and 10,000 12% preference shares of rupees 100 each. Whenever the preference shares are issued, the percentage of its return will be uh, disclosed along with the preference shares. So 10,000 12% preference shares of rupees 100 each. So the company is issuing two classes of shares here, and where it is payable as on application preference shares rupees 30, and for equity shares rupees 30, on allotment preference share rupees 30, equity share is rupees 40, and on calls preference shares rupees 40, equity share is rupees 30. So let's see how we will pass the journal entries. The first will be receiving the application money. So first we will receive the application money for the preference shares, bank account attached to preference shares. The application money for the preference shares is rupees 30 for 10,000 shares, 30,000. Then next we have to get the application money for the equity shares, bank account attached to equity share application, rupees 60,000. So it is the case whenever the companies are issuing two class of shares, the journal entries should be passed separately. So see here, whenever the company is receiving application money on the preference shares, the journal entry is bank account attached to 12% preference share application, and when it's received is equity share application, bank account attached to equity share application. The next they have to transfer this application money to the share capital, but there are two classes of share capital: equity share capital and preference share capital. So first, transferring this preference share application to the preference share capital, 12% preference share application to preference share capital, rupees 30,000. Then next you have to transfer this equity share application to the equity share capital, equity share application account data to equity share capital. Like this, we have to pass separate journal entries for the each and every of the cases, for every stages, for obligation, for allotment and calls. So whenever the companies are issuing two classes of shares, the journal entry should be passed separately. So if you want, you can make compound journal entry out of this. For example, for these two journal entries can be combined into one journal entry. How? Bank account HR. See, bank account HR, rupees 30,000 and rupees 60,000, total rupees 90,000, 90,000 rupees received, and this 90,000 is to 12% preference share, to 12% preference shares, and to equity share application. Here is 12% preference share application, and here equity share application. This one is 30,000 and this one is 60,000. So this journal entry can be combined and you can make compound entry. So that's for your convenience. If you wish, you can do like also. So this is for today's